I'm going to start out my presentation just with a little bit of an apology. I will not be able to do it in French. You have the option of either having it in English or in Danish, depending on your preferences. I'll probably stick to the former of the two, though. So my name is Peter Hafez. I'm the Chief Data Scientist at Ravenpack. For those of you who don't know Ravenpack, we are a news analytics provider. We have expertise within natural language processing, so turning unstructured content, primarily news and social media, into a structured data feed that we sell into the financial community. We have been around in finance. We have been around in finance since 2003, and we launched our first product back in 2007. And that has given us a unique opportunity to observe the marketplace of quant and how it has changed over the years. Back when we started out, the word big data or alternative data wasn't really around, but we have kind of seen how it has grown into prominence within the industry. And as part of my presentation, I'm planning to give you a little bit of an overview of what we have learned, or what we hear, or what we see in the marketplace when we speak to our clients. And just to give you an idea of the clients that we cater to. So of course, when we first started out, initially, the companies that were jumping into this space first were companies primarily in New York, and often within the statistical arbitrage space. If you look at the top 20 quantitative hedge funds in the world, we probably have 70% of them amongst our clients, but of course we also expand outside of that space. More recently, we have seen the interest in alternative data make it over to Europe, and by the way, we are a European company. But we have seen the interest in alternative data coming over to Europe as well, and Europe is catching up fast in the applications of alternative data. And I will come back to what alternative data is more specifically. Feel free to jump in whenever you want with questions. I'm more than happy to address them as we go along. One thing I will say is that there will not be a single mathematical equation in my presentation. But there will be a lot of, hopefully, nice stories and anecdotes. Cool, we'll do this one. So, one of the things that we have seen, or some of the statistics you might have seen already, is that 90% of all digital data that exists today has been generated over the last 2 years. And nearly 80% of that content comes as hard-to-consume, unstructured content, right? And of course, that offers incredible opportunities for investors to identify new alpha sources. So, as you may have seen, at least you did a couple of minutes ago, 90% of all data that exists today, digital data that is, has been generated over the last 2 years. And about 80% of that content comes as hard-to-consume unstructured data. And here, of course, we're talking about either text or imagery or voice, for that matter. And of course, with all of this data being generated, it also creates immense opportunities for hedge funds and asset managers to create new sources of alpha, or new alpha streams that may be potentially uncorrelated with what they already have within their existing model framework. And with all of this, with all of this data being generated, there is a new wave of data sources that goes beyond what has traditionally been feeding into trading models. And that's really where the term alternative data comes in. And alternative data is a subset of the big data space. Big data, of course, captures all kinds of data that is out there. Well, alternative data is a subset which is unusual as compared to what you would traditionally have incorporated. And of course, here we are talking about accounting data or market data, price data, volume data, and so on, which is typically what has been feeding into quant models. But now, or at least in the last few years, funds have started consuming much more diverse sets of sources. I have listed a few here, since they can generally be categorized in just a few areas. I have listed a few on the satellite imagery area. You see them on the left side here. So people or quant firms have started to a large extent to consume pictures taken by satellites, monitoring, let's say, parking lots outside of supermarkets, or can you say having satellites going over China and trying to figure out how much light is on, if you can get some sort of idea of what GDP growth might be in China, because you can't always trust the numbers that are considered official. I will say, however, that satellite imagery to some extent has been hard to incorporate for quants. It has been one of the more sexy data sets to talk about, that is capturing a lot of imagination, but often there are issues incorporating this type of data in quantitative strategies. First of all, because the universe of let's say, companies that you can cover is very, very small, and that is often not a nice feature for equity quants that often want to trade large universes. They like to trade a little bit more in a market that looks like a casino, or being the house in a casino. So they often get a small edge from alternative data, but they trade often in large universes, and then that can ensure that they are profitable more or less all the time. Satellite imagery doesn't really lend itself to that kind of trading, because you might just have a daily picture of a parking lot. If it's cloudy on a given day, you might not have such a big, nice, or such a great picture. And it also tends to be tilted towards more retail type industries and so on. But where it has been a little bit more applied is in macro, as I mentioned before, in macro trading, or also perhaps more on the discretionary side, where you have particular sector analysts that are focused on just, can you say, the retail sector. They have found value in these type of data sets. Other data that is being consumed out there is more on, of course, the social media side. And one of the things that people think about first is Twitter. And Twitter was probably hot 5-6 years ago. It died down a bit as more and more piled into mining Twitter, and realized that there probably wasn't as much value in it as people thought, or at least the value is very, very difficult to extract. It's a very noisy data set, and therefore it will offer you a lot of false positives. And you may have read in news, how Twitter broke a particular story first. And I actually hate those stories, and I operate in this business. I hate it because what those stories tend to forget is that, what about all the false positives? How many times did you have to trade on a wrong or bad signals before you got that one correct? I would definitely not use Twitter for event trading. It's definitely very risky to do so if you decide to go ahead with that. Instead, I would say, Twitter might be interesting from a wisdom of the crowd perspective, but what is much harder to figure out here is that if you look at, if you have an algorithm that wants to make decisions, how much of a crowd or a trend do you need to see in volume before you make a decision, as opposed to having a journalist also watching Twitter. And by the way, if you look at a company like Dataminer, who operates in the Twitter space, their biggest clients are amongst journalists. So journalists are sitting there watching Twitter, and the question is, who will really get it first? Will you get it first through a newswire where a journalist has watched Twitter or monitored Twitter and having gone in and manually verified it before putting it out on a newswire, or do you want to take the risk on consuming or ingesting Twitter directly into your algorithms? That's one of the things that are not really being addressed much in the media. I think there's a lot of interesting things in Twitter. For me personally, I think what will be interesting, or before I go to that, Twitter actually got a second life. it didn't last long, but when Donald Trump became president, we started getting a lot of questions about Twitter again, because people could see, of course, that he was tweeting a lot, and there must be value in tracking his tweets. That has died down as well. Not his tweets, but the interest in it. I do think that there is, can you say, a new opportunity, or there will be an opportunity in a few years for Twitter again, from a trading perspective. And that would be, in tracking consumer sentiment. So the problem is that if you are going after the wisdom of the crowds instead of wisdom of individuals, let's say doing a short list of an account that you might track, which people are doing and finding value in. But if you want to really go for the wisdom of the crowds, I think Twitter is more about consumer sentiment. And consumers don't tweet about companies. They tweet about products and services that they want to consume. So they will say, I love the new iPhone X. Or they won't say iPhone X from Apple. They will say, I love the new Audi Q5 or the new Peugeot. I should probably mention Peugeot here when I'm in France. But they won't, but the good example with the Q5 is that it's owned by Audi. It's an Audi, right, Q5. But Audi you cannot trade unless you trade credit. You need to trade Volkswagen, who owns Audi. So you need a graph that maps all of these various entities together. And if you look at products, those databases just don't exist commercially. There's not a good database which is point-in-time sensitive of products, and therefore you cannot, with current technology, track consumer sentiment from Twitter. Other things that people are looking at: weather data, location data, foot traffic data. So how many people are walking in and out of Chipotle? That's a well-known example. People have been tracking credit card data. So when you go to your bank account and you now see, it's very well and nicely organized in your account, how much money you spent on groceries this month, and so on. The companies that are delivering those apps also sell data. Of course, in an anonymized fashion. But that data starts to become available to the quant community. And of course, there in the middle, you have Ravenpack in the news analytics space with no obvious competitors. So one of the things that you have seen in the marketplace is that there are funds out there that have invested very, very heavily in bringing in alternative data within their investment process. And some of these companies very early on started hiring dedicated data hunters. So they were traveling all over the world to figure out what companies may sit on interesting data. Because of course there's been a lot of apps that have been introduced and so on mobile phones and other things as well that have happened in the Internet of Things. So they have been out there with, trying to be creative and say, who can we contact and get data? And they had a real competitive advantage. The ones that started out in this space 5, 6, 7, even 10 years ago, hunting down data. However, that, can you say, advantage is slowly disappearing. So the market is for sure maturing. And we have more and more sell-side research reports coming out that are highlighting interesting alternative data sets. Last year, there was a very greatly celebrated report that came out from JP Morgan, 260 pages for those who wants to read it, focusing on big data and machine learning in finance. And they also listed, or the report also listed about 600 companies that you might be interested in if you want to dig into the alternative data industry. And there are many other reports out there that showcase or highlight various alternative data providers that you might want to take a look at. So there is more and more help out there on how to get started. So the advantage that you have in hunting down data sets is diminishing. But of course, what I've talked about here, there are some of data sets that are more or less dodgy from a legal point of view. And of course, one of the things that that the funds are very concerned with is, of course, if they have a very strong compliance team, so they're obviously very aware of what data sets to consume and which ones they shouldn't be consuming. And we are definitely getting across people that or firms that say, you know what, this sounds like a very interesting data set, not the ones that we sell necessarily here, because all what we do is public information. But we have come across firms that say, okay, we have found this great data set, but we don't really dare to consume it purely for compliance reasons, and therefore this kind of thing, this slide becomes very relevant. Make sure that data is legal. And it is definitely on top of the agenda. So if we take a step back and say, why alternative data? It's actually quite intuitive. If we start all the way on the right-hand side, you can say, what are we interested in when we decide on what companies to buy or sell? Well, at the end of the day, we're interested in booked sales, right? How much money or how much revenues does this company have, and how much of that turns on the bottom line? That's really what we're trying to get to at the end of the day. How do we get there? Well, we could look at their accounting data, right? But it's often delayed. So, for instance, in the US, the earnings season is quarterly, and it's always backwards looking, right? There may be some guidance and so on coming out about what might happen in the future, but when the numbers come, the hard numbers come, they're already old. So how can we potentially get something which is not old, which are more like a nowcast of what is happening around companies? We can go to alternative data. And on this slide, I have listed various alternative data sets that you can potentially use to get an earlier read on that fundamental number that you're interested in. Credit card data, of course, is faster. So you're actually trying to capture at the register when people make their transactions and buying goods and services, what you're getting it at that stage and already getting a sneak peek into what will the accounting numbers be when they are published during earnings season. So you can take one step sooner and get a more real-time input, or at least daily input, on the revenues that a company has. Of course, you only will be able to look at a subset of the total revenues, but at least it may be enough to give some sort of sense of where revenues are going. You can take one step further back and say, okay, I will actually capture people using satellite imagery of taking pictures of parking lots, or GPS traffic data, so people as they walk into the supermarket. So you're capturing it not at the till, but when they actually walk into the store. Of course, you can see it's earlier than capturing at the till, but it's probably also noisier data, right? So you are getting a speed advantage as you go towards the left of this screen, but you're giving up on accuracy as well. So there is a trade-off. The last thing I highlight here is that you could also go onto online search and web traffic and blogs and social media and capture people when they have an intent to buy, even before they decide to go to the store, but just thinking about doing it. And of course, that's the earliest stage in which you can capture the behavior of consumers. But again, you're going to consume much noisier sources. But that's really the idea or the intuition behind alternative data, trying to capture people earlier in the cycle so we can get a better read, or an earlier read, not necessarily better, but an earlier read of book sales, and that I can make money on. So I just wanted to give you a few examples of what you can read out of, let's say, receipt data. This is based on email receipts. So people, if you go to Amazon or some other website and you buy a product, you'll get an email receipt in your inbox, and this graph is built on that type of information. I just took out 3 examples that I found a little funny or interesting. This one is for Victoria's Secrets. They sell lingerie. But what's interesting to see here is that when do they make the sales? You can see there are 2 distinct spikes. They're around Christmas. So it's probably husbands buying sexy lingerie for the wives, and there's not really much sales in between. If we take the next one, there's another one, and that's what I call the New Year's resolution. This is Weight Watchers. So when do we diet? It may be after we get sexy lingerie, I don't know, but this is just after Christmas, right? And after New Year's. I want to lose weight. So Weight Watchers have most of their sales in the first few months, and then it kind of dies out, and then they wait for next New Year's Eve resolution. That's how Weight Watchers make their money. This is another one. I'm not saying it's related, but it could be. So after you have bought some sexy lingerie and your wife thinks that I need to lose a little weight before wearing it, you need to try and make it feel good. So you buy flowers. And in this case, these are 2 flower companies. And what you can see here is there's 2 distinct spikes as well throughout the year. One is Valentine's Day. That's very close to Christmas and New Year, so that's good. So we can recover fast. The other one is Mother's Day. So you also have to be good to your mother as well. But all of these patterns make sense, and that's of course nice to see when you look at this type of data, that it makes sense. But there's a lot of interesting things that you can see, and you can see if the business is primarily seasonal. Let's say if you go to mobile companies, you can definitely see that you pay your monthly mobile bill. If you go to fast food chains, you can identify when there are big sports events happening. Then people do more fast food. Also, you have that after New Year's. That's another one. So the 1st of January you buy fast food, and then the 2nd of January you go to Weight Watchers. But coming back to and talking about alternative data and what companies are doing to get an edge in the marketplace. I told you already that the edge is no longer being, can you say, the first or the only one necessarily having the data. But that's kind of a little bit how people traditionally have been thinking in finance, that you can make a lot of money having proprietary data or information, right? But that edge is diminishing as well. And the real edge today is found in efficient processing of data, not being the only one having it. I think it's a little bit old school thinking that way. Of course, there's some truth to it, but so I'm generalizing a little bit. But I think, of course, if you are someone like Google or Facebook or Apple or Amazon or Microsoft that sits on piles of data around consumer behavior, you will surely have an advantage. And if they decided to start up a hedge fund or something like that, I'm pretty sure they will do well. And actually, there's probably some trading going on for prop money in some of those shops. I would be surprised if there wasn't. But otherwise, what you will see is that, on this previous slide or the slide earlier, where I showed various potential providers in each of these different alternative data buckets, you can see there's not just one company operating in each bucket. There are multiple companies. And a lot of those data sets that they offer will have some sort of correlation between them. So you might have one of the data sets in some sort of proprietary way, but there will be 99 other data sets catering for that kind of data. And they will be highly correlated, so you don't really have an informational advantage. And so it's generally just much harder getting that informational advantage, also because at the end of the day, we are trying to now cast fundamental information. We are just coming at it from various angles. Another thing that we are seeing in the marketplace is that the alpha landscape is changing. And that's also one of the reasons for why people are so interested in consuming alternative data. If you go back to the 50s, there were few factors that were driving asset prices. And here you can talk about, your momentum and size and value and all of these. And these few factors tended to decay very slowly. So what does that mean in practical terms? It means that you can invest a lot of money in those type of signals because you don't have to move in quickly. You can build up your portfolio over time, so they are very scalable strategies you can build, or at least back in the days. What you're observing today is that there are more, each of these blue lines here represent a potential factor, alpha to trade. And the length of the line is basically representing decay. So what you can see here is that there are thousands of potential alphas that you can consume, or alpha data sets, sources that you can consume today, but they are also decaying much faster than what we are used to. What does that mean? It means that if you want, as an asset management company, to keep the same AUM, assets under management, as you have been used to, you need to consume an increasing amount of data, because each alpha gives you less value and it decays faster, so you have to trade it faster. That means that there is less capacity in each one of them, so you need to trade a lot of different alphas to allocate all the capital. And that puts an enormous pressure on cost. So we need to be able to take a given data set and very, very efficiently turn it into alpha. And as I started out saying, a lot of this alpha comes as very hard to a lot of this new data comes as very hard to consume data. So we need very efficient data processing, turning data from unstructured to structured as cheaply as possible. And that's really where some of the funds in the US today that are being extremely successful, they are very, very good and efficient in turning data sources into alpha streams. There are one company in particular that has been a little bit more public about it, called WorldQuant. So I can talk about them. And WorldQuant, they are basically a spin-off from Millennium Partners, which is a very big hedge fund in the US. I think in 2016-17, they consumed 1,000 new data sets. That's a lot. Because we're still not really in a black box type of framework where you just take a bunch of data, put it into a black box, and alpha comes out. There's still a lot of humans involved, right? But WorldQuant has been extremely successful, and the Two Sigmas and the Renaissance technologies of the world are being very successful in consuming lots and lots of data. Of course, as I've kind of alluded to a little bit, it's not only putting a lot of pressure on cost, it's putting a lot of pressure on infrastructure. You need to be able to consume all of this. And that's why cloud, of course, is almost heaven sent. But it also still takes people, right? And that's why you have seen new models come in. You may not have thought about it much, but it's really why there's such big focus on this. I don't know if you have heard about Quantopian or Kaggle. You have probably heard about and Numerai and all of these. So this is why this new trend is coming, and I call it centralized versus decentralized quant alpha, taken a little bit from the blockchain kind of terminology. You need people. People are expensive. So how can I transfer the risk from me to someone else? I create a platform where people can come, data scientists can come and compete. So the individual data scientists have their cost. I just create a marketplace for them to have fun. But if I identify people that, what I'm trying to do is try to identify people that might be good at looking at data. And when they have found some value and I have validated the value, I will start allocating. That's really the Quantopian numeri kind of approach to it, and to some extent Kaggle. But you have kind of seen two camps in this space. You have seen the new guys on the block and the more traditional firms. The new guys have basically built a platform where you come and you compete and you can be selected and they will allocate capital. I call that crowdsourced alpha or crowdsourced research. Then you have the other side of the equation, and that's the more traditional firms or the big institutional firms like Winton, Two Sigma, or WorldQuant. WorldQuant has actually built their own platform similar to Quantopian. However, they will hire you if you're good. And that's the approach that you see over here. They take a different angle to it. They use platforms for recruitment, not for outsourcing research to some extent. So they will hire you. So Two Sigma has run competition on Kaggle to identify talent, because there is a true talent war in data science. WorldQuant created their own platform, as I mentioned, making data sets available to you. And if you're good, they will hire you as a consultant. You can sit wherever in the world you want. That's their model. Winton has also run competitions and been very open trying to recruit people. So those are the two sides. One of the disadvantages that you have with these guys over here, especially Quantopian, is that you won't be working with premium data sets. No premium data provider will ever allow their data set on one of these platforms where it's free and available, or at least very, very inexpensive. I think you can have a data package for $100 a month on Quantopian. No premium data provider will be able to sell at those prices. So you're working on not so great data that all the institutional guys don't really want to buy. So the guys are trying to say, okay, we can at least go to retail and get $50 a month. So that's the kind of data you'll get there. Numeri has tried to solve that by encrypting all of the content. And so you don't really know what you're looking at, and you're just saying, okay, let the best data scientists win. The ones who know how to look for patterns in data. But what you lack here, and that's also a debate that is ongoing in finance, especially with this big emphasis on AI and machine learning, that is, how much does domain expertise matter, as opposed to just considering things as data and signals? Numeri is really a data and signals model. So there's no way of getting any domain expertise within any data set because you don't know what you're looking at. And it's very interesting what's going on over here, but it's still very unproven. If you look at someone like Quantopian, they raised 250 million from 0.72, which was the old SAC. I think they have been able to identify something, I've heard 50 people that they've been able to allocate to amongst 300,000 people on the platform. And I think they only have invested about 50 million at this stage. Numeri kind of disappeared for a while. I thought actually they might have died, but they have just popped up recently. They say they're performing pretty well, but I think it's still probably an unproven model. But it's going to be very interesting to follow. So now we're getting to Ravenpack. Where do we fit in all of this? As I've kind of already alluded to a little bit, we have expertise in natural language processing. So we help companies turn unstructured content into actionable analytics. And of course, it's part of that whole idea of trying to make it available at a lower cost and more efficiently than, can you say, having to build an engine by yourself. We have spent a lot of time and money in building our algorithms. It's taken us about 15 years, and there's still a lot of work that can be done. Technology is improving all the time. And what we can do today is miles ahead of what we were able to launch as a product 10 years ago. So what are the things that we do in order to add structure to content? Well, we focus on a few key attributes. We do entity detection. We track companies, people, products, places, organizations, currencies, and commodities. And we do that in a point-in-time sensitive fashion. And that, of course, is key for quants. If they need to be able to backtest, you need to have a database of all of these various entities that you might consider. Going all the way back, we do it all the way back to year 2000. So it's a lot of data. We have more than 250,000 entities that we track in the news. And that's the very first thing we do when we see a news article or a textual document coming in. We will try and look for, are there any entities that we're interested in that we wish to identify? The second thing we do is that we also look for events. So you can have a given mention of a company, but we'd like to also highlight context. So we try to look for what role does this particular entity play within a particular event. Is it an acquirer or an acquiree in an acquisition? Is it the plaintiff or the defendant in a lawsuit? Is the company laying off people? Is the company issuing earnings? Is the earnings above or below expectation? And so on. We cover something close to 7,000 different types of events within a taxonomy. And we have different layers that you can work on. At the very top, we focus on business-related news, economic-related news, societal, political, and environmental news. And what's interesting about introducing all of these dimensions is that we don't believe, let's say, in one sentiment score for the US economy. It's a very simplified way of looking at the world. We believe in multiple sentiment dimensions. And different dimensions are important for different asset classes at the very top level. If you want to trade equities, you'll see that mostly equities are driven by company-specific news, even at market level. So it's really about bottom-up. At least in the shorter term, economic news tends to have a little bit of a longer-term impact. If you want to trade commodities, it's about economic news, but also political, societal, and environmental news. But they will impact at different horizons. Forex and interest rates is all about economic news. And of course, single equities is mostly about the news on the companies themselves, but also news on suppliers, customers, competitors, and so on. So people benefit from building graphs of related entities. We will also, after we have scored for or detected companies and detected events, we also score for relevance of those entities and events within the article. Was the company, for instance, detected in the headline? Was the event, were the event detected in the headline? Or was it detected deeper in the story body? And that's also important. If you look at large cap companies, for instance, in the US, on average at least, they're very much headline driven, which is not a big surprise. We tend to consume our news and headlines on a Bloomberg terminal. And that is what's driving prices. However, as you go towards smaller companies, story body matters more. It's much harder for a small cap company to reach the headline. The same goes, it also depends on the source. Are you looking at more US-centric sources, European-centric sources, and so on? If you look at a US-centric source, European companies just have a harder time reaching the headline. And therefore, you need to put more emphasis on the body. So you need to be able to figure out what the prominence and the position of the events that you detect, what they are within the articles that you analyze. We also do novelty scoring. So how new is the information or is the event that we are detecting? Is it the first time that you have seen it? Have you seen it 10 times over? What's the buzz? That might also be informative. If you want to trade very short horizons, you want to filter for novelty. If you want to perhaps look at it in a longer time frame, you might want to see how broadly has it been disseminated, how much coverage has it had, and that might give you additional information. And I have an example to show of that. How am I on? Okay, perfect. And finally, and I think probably what we are most well known for is sentiment. And here again, we don't believe in just one sentiment score. We believe in one or in multiple sentiment dimensions. also in how you extract or measure sentiment. We have sentiment techniques that are event aware. So it knows that it's a layoff. It knows that it's an earnings above expectation event and so on. And we have gone out and surveyed a panel of analysts to say, you know, layoff, is that generally good or bad? Earnings, is that generally good or bad? And to what extent? And from those type of surveys, we were able to get upper and lower bounds for each of the event categories that we have. And then we go back to the news to extract additional information, positive and negative language or magnitude. How much did you beat expectation? How much were you up or downgraded in an analyst rating and so on? And the main reason for why we go out and do that survey in the first place is that what about a word like up? That's positive. But what about if it says earnings up versus stock price up? It will have very, very different implications in terms of predictability. So it's not just enough to look for positive and negative language. You need the context. So if we see up related to an earnings event, we will move the sentiment more extreme based on the range of the upper and lower bounds, as opposed to if it's for stock price, where we have already, can you say, we have a much more narrow range that the sentiment score is allowed to move in. We also look at more traditional techniques like bag of words, looking up bi and trigrams of words, a combination of words. And what we find is that the event, what we call the event sentiment score, is generally very, very strongly predictive. But it's stronger on short horizons because it's also, the underlying thing is that it's event driven to a larger extent. So it has very high information ratios, but it decays fast. We're talking days up to, you know, a week or two, depending on your trading universe. But if you go to some of these other techniques that may be less strong, like bag of words or base classifiers and so on, they will be weaker to start off with, but they decay more slowly. So they're capturing other types of patterns in sentences or in documents. So you can benefit from having different types of sentiment analytics and figuring out what is my use case. How should I use it? There's a lot of third-party research, and I know I'm running out of time, so I'll go a little faster. As I mentioned, we have been around for 15 years. We probably have 50+ papers done on our data. Some of it is done internally by my team within Ravenpack. Some of the research has been done by academics, like Paris Dauphine. I don't know if I pronounce it correctly, but there's been quite a bit of research done on our data. There's also a lot of sell-side research done. So some of the more recent and prominent studies, you know, Deutsche Bank looked at pairs trading, filtering pairs trading strategies, and said, okay, if I see divergence between two companies, there could be a fundamental reason for why that divergence took place. So I want to filter my pairs trades by saying, if there's been abnormal news volume and negative sentiment, I'm not going to bet on convergence. They may just continue to co-integrate, but at a new spread level. And they were actually able to reduce the non-convergence risk by about 50% with the news overlay. There's also been research done, you know, filtering valuation or momentum strategies and so on, either done by JP Morgan and Macquarie. So there's quite a bit of proof out there. And of course, that people have been trading off this data for more than 10 years is also proof. So it's not just nice stories, there's actually value in alternative data. This is some of the research that has been done by FactSet. This is on Russell 2000, so small cap US companies. And they built a rolling 1-month sentiment indicator and dissected the universe into quintiles. And looking at inactive returns, so basically removing the market, so it's a spread to the market. And what you can see here is that positive sentiment stocks, that's the top blue one, surely outperforms negative sentiment stocks, and that's the bottom line here. So you can actually have a quite nice spread, and it stacks up quite nicely here when you look at the order of the quantiles. This is with 1-month holding periods, by the way. We have done similar research internally, but looking at 4 different universes. The first column large mid-cap US stocks, so Russell 1000. Second column, Russell 2000, and the European equivalents. This is with 1 day holding period, so very high turnover. So the challenge here becomes, how do you implement it? There's no transaction costs. The challenge becomes, how do you implement it? But often people consuming a simple signal like that is so fast, will be required to combine it with other signals. And there are companies out there that have thousands and thousands and thousands of alphas, so each individual alpha doesn't have to carry the transaction cost. They're just looking for what is the marginal contribution to turnover. And therefore, they can trade signals that other people cannot. This is very fast. So, but as you can see here, the information ratios are very high. About 2.5 for large caps, 5 for small cap. However, the capacity is also very small. So as you start to push a lot of equity or AUM through it, information ratio will go down really, really fast, right? There's liquidity constraints. This is without any of that. This is what it looks like. The other performance was in excess returns. So it was dollar neutral. In this particular case, the blue line basically represents what I showed before in the table. The red line here is when we try to remove traditional factor exposures. So we have taken specific returns out of a MSCI risk model. And as you can see, it's this type of factor, at least on this very, very short horizon, is uncorrelated with more traditional factors. It doesn't take anything away from a return perspective. In fact, it reduces volatility and you actually get a little bit extra return out of it. So it's uncorrelated. That is, of course, not true on all horizons. If you are to aggregate sentiment going from 1 day to 1 week to 1 month to 3 months to 6 months, eventually we will look like price. We will look like momentum. But we do not look like momentum in the short term. The question is just what is short term? It depends on the trading universe, for sure. Large cap, small cap, US, Europe, emerging markets. But eventually information will be incorporated into price. But we definitely are not operating in efficient markets. This is a similar thing. I've just overlaid it with what we call event buzz, and saying you not only have positive and negative sentiment, but you have a lot of news volume to support it. The purple-ish line, I don't know what it's called, the color. The top one is if you focus just on the companies that are the top 20% of companies that has the most news volume to support it. And then you trade a long-short strategy. You're able to get twice the return out. So news buzz matters. You get stronger signals, but of course, you have to give up on diversification because the portfolios get smaller. And it's always a trade-off between trading larger portfolios versus stronger signals. What's the right thing to do? Depends on your individual objective function. This is a very simple objective function, and all I've shown you, the objective function has just been, let's optimize information ratios. The last slide I want to show you from a study perspective is just to show there's also work done on the macro space. Most of alternative data does cater mostly for equities. However, more and more data sets are turning up in macro. Macro is harder. Macro is much harder than equities. Equities is easier because if you have news about companies, it's very likely going to move the company price. Equities, you can have news about, that doesn't mention a commodity that will drive commodities prices, or news that mention currencies that will move currencies. In fact, news that do mention currencies will not move currencies at all, because the currencies often appear when people talk about prices appreciating or depreciating, and at that point it's too late. Or technical signals, which on average holds 0 value when you extract it from textual content. You need information about GDP and unemployment and all of these things. For commodities is a little different. There you do have commodity-specific news like export and import taxes and drilling and stuff like that. And that's the stuff that has been used here. So this is an event-driven signal we did. We applied various machine learning techniques on a sparse matrix, event matrix. And we then created an ensemble strategy. And we condition on volatility regimes as well. So what we find is that the signals tend to work better when volatility is high versus when volatility is low, seen from an individual instrument perspective. We end up, again, one-day holding period, still high turnover, but of course this is futures trading, so it's a little easier to trade and cheaper. Information rate is about 1.2 out of sample. Out of sample from 2015 until today. The in-sample period obviously comes prior to that. So in conclusion, the asset management industry is becoming increasingly competitive. And therefore, people are searching for new avenues for alpha generation. And with the proliferation of social media and mobile data and apps and all of these type of things, Internet of Things, it's becoming, of course, that's a very natural way to kind of look for new alpha sources. However, natural language processing becomes very, very important as a technology. And more companies are either investing themselves or collaborate with vendors to address all of this unstructured content. And what we have seen in the last probably 2 years is that this space is moving from a nice to have to a must have. People know or are convinced now, as opposed to a few years ago, that we have to be in this space. And therefore, the space is moving fast right now, both in the US, outside of the top quant funds, but also in Europe. Thank you very much. Yep. I think one of the things I want to say is that a lot of NLP engines today operate only in English, and ours does that too. That means that you have less content in Asia. So I think in Asia, perhaps specifically, you can benefit from going into local languages. And I do also think that there are great opportunities in Asia for sentiment analysis or natural language processing of content for multiple reasons. One, because it's harder, and you do get a speed advantage by doing the local language. And also generally you'll see that information decays more slowly as you move outside of the US. US is pretty fast. Optimal, as I mentioned before, is a couple of weeks, where in Europe it's slower and emerging markets are slower, and Asia is also slow because of that. But also I think there's an increased interest there, but liquidity isn't as great. People tend to perhaps focus a little bit more in Japan, but we are seeing increased interest in China, and I think there are opportunities there. But unfortunately, it's not opportunities that we are going after right now. So I know it doesn't address your question directly necessarily, but we don't operate much there, so I don't have too deep insights about the Chinese markets. From a product perspective, we do not. We are in the business of classifying content or structuring information, not in making predictions. So we are just an input to a model, and then you need to figure out what's driving prices, and you get the confidence intervals out of your modeling process. Of course, what we're focused on in precision and recall in terms of whether we are right or wrong and how we classify it, but we are not necessarily training on price data when we do it. We just want to represent the information as it is and as correct as possible. But it is a challenge in the commodity space because, when you have news about IBM, it's probably going to impact IBM. But on commodities or currencies, you need to make that inference. And macro generally there's much more, let's say, information that you need to dig out between the lines. If you look at Fed speeches and stuff like that, is the Fed governor dovish or hawkish? It's much harder of a problem than if you go to equities where they may be, besides perhaps earnings transcripts and stuff like that, it's more clear, it's a little bit more factual, I would say. Yep. Yeah, so whenever some news hits our engine, we take about 200 milliseconds to process it. How quickly it starts getting incorporated in price, it depends. There has been studies. There was an interesting academic study done by INSEAD, Wharton, looking at our data, where they had access to multiple versions of the Ravenpack data set. And they looked at when we had reclassified content over time, and then saw how did that impact prices. And more specifically, they looked at when we used to say that an entity was highly relevant within an article, and now we said it's not. And that was driven by us increasing our coverage. So we went perhaps from covering only 10,000 companies to 45,000. And the number of companies we detect within an article is a metric in relevance. So the more entities we detect, the lower relevance each entity will have. So what they found was, which was quite interesting, that of course, when we classified something from high to low, that's specific to Ravenpack. And they actually found that the market would react more or less immediately to this type of content. And if we said it was highly relevant, the market would treat it as a highly relevant news. So it would perform just as if it was truly highly relevant for about 30 seconds. And then it would trade down again. So the market would catch up and say, no, this is not highly relevant. So, and then it would revert. So what's interesting here is two. One, the markets are fast, and two, Ravenpack is part of the market. So of course, taking the little sales hat on. So if you want to understand exactly what's going on in the market, you need to buy Ravenpack data. Any other questions? Yep. So we source our data from, so we have primarily been focusing on news and social media. And social media, it's more like prominent blog, like Seek and Alpha. But we source it by going directly to news providers. So we have a partnership with Dow Jones. We have a partnership with LexisNexis, which is an aggregator. We have also partnerships with Benzinga and all other kinds of news wires. And the products that we offer is, you just come to us, we pay licenses or royalties back to our providers. It's public content. Yeah, that's currently what we analyze. However, we are moving more and more into the space of analyzing internal content. So clients that have been with us for many years, like the analytics we produce on news and social media, and they say, can we start running our own stuff through it? It may be news sources we can't get hold of, like Bloomberg and Reuters. We don't have that, only web content. But they have competing products, and they have not been interested in selling to us. But companies might have it themselves, and they want to run it through our engines. It could also be email, analyst reports, earnings transcripts, filings, and so on. But generally, all the content that we analyze off the shelf is paid for public content.
you.